Hey everyone, we're back again with another video, and in my last one I talked a little bit about mortgages, but today we have our mortgage expert here, Peter Appolito from Finance of America. So we're going to go over a little more in depth about mortgages and options you have available to you, as well as some tips. So let's get to it.
Hi, thanks for having me again. It's Peter Appolito. I represent Finance of America. We are a full-fledged mortgage lender, and I've been in the industry for just a little bit over 35 years.
Alright, so today I'd like to talk a little bit more about property investing because we see it more now than ever. You know, HGTV is always on and people love those shows, so more and more people want to get into it. So what options are available to investors looking for their first investment property?
Good question. And it is becoming more and more prevalent, especially in this climate that we're in. The biggest challenge that first-time investors have is the down payment. The down payment varies greatly depending on the type of property that they are looking to purchase. I'll give you an example. If it's a single-family home, the minimum down payment on an investment property is 20%. If it's a two-family or multi-family home, anywhere from two-family up to a five-family, then the minimum down payment is 25%. That's the biggest hurdle, especially with a first-time investment buyer.
Okay, and I also understand there are some qualifications on the property itself. So to the extent that the property is so distressed that mortgages aren't available, can you go a little bit more into that?
Sure. I think the biggest thing we need to establish is on an investment property, the investment property income has to carry the mortgage payment. So let's make it simple. Let's say we have a $2,500 a month mortgage payment, including the property taxes, including the homeowner's insurance, and the principal and interest. Let's also assume it's a two-family home. We have to have a minimum of $3,000 in rental income, even though the mortgage payment is $2,500. The reason being, your monthly revenue on the property has to be at least 25% higher than the mortgage payment. The reason being is Fannie Mae, Freddie Mac always has that variable come into play to just in case a tenant moves out and you have to carry the property on your own. So just keep that in mind when you're taking into consideration the payment and the rental revenue.
Awesome. So let's say an investor wanted to come in and do some work to a property. Can you talk a little bit about a 203K loan and if you see them commonly used and if you think they're worthwhile?
Good question. On an investment property, you cannot use a 203K. A 203K can only be used on a primary residence.
So let's say someone wanted to switch their residence for a year and get a 203K loan. Is that possible?
As long as it's their primary residence and as long as they're going to sign a waiver that says they're going to occupy that home within 30 days, that's the only qualification. Now, things change all the time where people move, people get relocated. Nobody has a crystal ball on where they're going to be a year from now. So as long as they're willing to sign the waiver that states that they're going to occupy that residence as a primary residence, then yes, they can. The other thing to keep in mind is you can only have one FHA loan at a time. So if you use up your FHA loan when you buy this primary residence, 6 months from now, a year from now, you cannot use an FHA product unless you pay off or sell that first property.
Very good to know. And another term we always hear in property investing is hard money, hard money, hard money. So I wanted to get your opinion a little bit on hard money loans because, you know, people think that they have to get into hard money and hard money can eat at you really quick. So
hard money is exactly what it means. It's hard money. I like to refer to it as almost as a last resort. The reason I say that is investors that lend money will not, for the most part, lend hard money to a primary residence because it's very difficult to evict someone from a primary residence. On an investment property, to give you an example, the interest rates are probably going to be over 10%, and they're probably going to pay in excess of 4 points. Now, what is a point? A point is 1% of whatever you borrow. So let's make it simple. You borrow $100,000, it's going to be $1,000. You borrow $1,000 per point, so it's going to cost you $4,000 and have an interest rate of at least 10%. Normally, those loans are good for 12 months. After 12 months, it becomes very expensive, and normally they want to try and refinance you out of that loan because they don't want their money tied up in the property.
So, Peter, before, I know you mentioned that Finance of America does commercial loans. So, can you talk a little bit more about that, as well as if there's any perks for someone who's, had more than one investment property that they've closed on?
Sure. Good question. We have a separate lending division known as Finance of America Commercial Lending. Now, the beauty of that particular division is if you own or have owned an investment property in the past, we give you the ability to get into our fix and flip program. That fix and flip program can give you an instant up to a $1 million buying power based on your current asset situation and based on your current income situation. The only way to get into that particular program and get that particular credit line is to have owned or have currently owned a investment property. It's simply based on your credit, your assets, and your income.
And let's talk about refinance for a moment. Do you see a lot of refinances happening with how low interest rates are?
Well, I could tell you that refinance represents probably 60% of my business. In this market this year, it's probably represented 70% of my business. The thing about Finance of America, and I'm glad you brought up that question, is we offer a no-cost refinance program, and it's very important to anyone that has closed a loan with our company. And what that simply means is this. Every time your interest rates goes down by 1/4 point, give you an example. Let's say you're sitting at 3.5% currently, and the rate today is 3.25. What we do is we will come back in, and we will lower your rate at no cost, provided that your credit score is still what it was, your income is what it was, and your assets are what they were. We will come in and pay all your closing costs, including the title work and the attorney fees. And that particular program is unlimited throughout the life of the loan.
And speaking of income, assets, liabilities, what are some do and don'ts when you're preparing to get a mortgage?
That's another good question. I'm glad you brought that up because it's the mistake that a lot of people make, and I brought this along with me just so I didn't leave anything out. We'll go over them briefly, and there's several of them. There's more don'ts than do's, that much I can tell you. And some of the don'ts are: don't change your job, don't quit your job, don't become a self-employed person, because if you're self-employed less than 2 years, your income is useless to us. You cannot use it. You will not qualify. So keep your current job at least until you close. Number 2, the mistake that most people make is they go out and they buy a car, or they buy a truck, or they buy a boat, or they co-sign a loan for their children, whether it be their son, their daughter, their wife. Anything that you co-sign for is your debt. Now you may say, well, it's not my debt, it's my kids. Well, it's your debt. If your child defaults on that loan, guess what? You have to pay for it. Credit cards. I mean, the mistake most people get is when they're buying a home, well, they go out and they buy furniture. They go out and they buy window dressings or appliances. Do not do any excessive charging prior to closing, because if your ratios move, guess what? You're not going to close. Don't spend the money that you have saved for your closing costs, because when it comes time to close, if you're short funds, well, guess what? You're not going to close. Don't apply for any credit prior to closing, because it's going to show up on your credit report. In this COVID environment, we have to pull every borrower's credit report 3 days prior to closing. So if you have any new credit on your credit report, you're going to have to give us new statements on that particular card or car payment. You're going to have to provide statements that show that these are paid on time. And God forbid your ratios are higher, you may not qualify for the mortgage. So don't do any of that prior to closing. Another important mistake that people make is they go open up a new bank account. Don't do that, especially if you're going to transfer funds from bank A into the new bank account, because that becomes problematic because we need 2 months worth of statements. So if you're 30 days from closing, we can't get 60 days worth of statements. So don't do that at all. The other big mistake is no large deposits. Well, what's a large deposit? Anything over $1,000 is a large deposit. So if you sell a car and you put $5,000 into your checking account and we need that bank statement, we have to do what's known as source the funds. Well, I sold the car. Well, okay. And not to say you're lying about it or telling a story, but we have to verify and justify anything over $1,000. So if that's on a bank statement, we've got major issues. Those are just a few. I can go on and on and on, but those are primarily the most common mistakes that people make.
Yeah, those are going to be really helpful for people to know, because I don't think people realize everything that gets looked into when you get a mortgage, and things that can impact you and things that can impact you closing on the property. So real quick, I just want to talk about self-employed, because I myself, as an agent, am self-employed, and tax write-offs and everything are a big part of operating a business, and that, I understand, impacts your mortgage and how much you qualify
without question. And like I tell all self-employed borrowers, it's great to be self-employed because you've got the advantages of the tax laws. However, when you're applying for a mortgage or a loan, well, guess what? We go off what's known as your adjusted gross. Your adjusted gross is, let's make it simple. You make $100,000 a year. You expense your marketing, you expense your vehicle, you expense your office. Whatever you expense comes down to your adjusted gross. Whatever your adjusted gross number is, that's the number we use to qualify you. So if you made $100,000 last year and your adjusted gross is $30,000, well, guess what? That's the number we're going to use, the $30,000, not the $100,000 that you got 1099 for.
So it would be beneficial for someone to maybe ease up on the write-offs 2 years or so before they think they're going to be looking.
That's 100% accurate. The other thing to take into consideration on a self-employed borrower, depending on the type of industry that you're self-employed in, is what's known as depreciation. Give me an example. Let's say you own a factory where you buy a lot of machinery, and you're going to take that machinery and depreciate it over a certain amount of time. That depreciation will be added back into your income. So whatever your adjusted gross is, we take that number, add the depreciation to it, and that will determine your new adjusted gross income.
Awesome. So another quick tip I heard is, instead of depreciating something in the first year, you can depreciate it and spread it out, so your gross doesn't get knocked down so much in those years that you might be looking to get a house.
That's correct. And again, keep in mind, when you're self-employed, we look at 2 years, not 1 year. Although, in our system, if we put your loan through our engine, a lot of times we come back with only a 1 year finding. So if we get lucky, we'll only need 1 year return instead of 2. So that's a possibility also.
All right, Peter, I want to thank you again for sitting down with us and taking the time. We went over some really helpful tips today, and
Great.
I hope everyone finds it beneficial.
Again, thank you for having me. Any of the information that we discussed today is available in an email, is available in a brochure. Just ask Jared to get in touch with me, and I'll be more than happy to email it to Jared and or yourself.
All right.
And thanks for the time.
Thanks again, guys.